All right, well, welcome back to Real Estate Syndicator Live, episode 28. Super excited to do this one. Top questions to ask your deal sponsor. I originally wrote something similar. I did like a checklist back in the day when I was actually syndicating, because I thought it was in our self-interest to sort of, hey, this is the questions you should ask of a good syndicator. And I knew that, we were really good in all the answers. And so that was kind of the original impetus behind the checklist that I did back then. And then I realized, when I kind of got back into the law firm piece, that, it's actually something that's pretty valuable, not only obviously for passive investors, but it helps them figure out what questions to ask, but it really is helpful to syndicators, because it's always better to get things like this as from an independent third party, because it's, again, kind of self-serving when you say, hey, Mr. and Mrs. Passive Investor, here are the questions that you should ask. And oh, by the way, I'm really good at all these answers, versus, hey, here's a third party, here's a blog, here's an article, here are some of the questions you should be looking at. I encourage you to review those, and hopefully you score well on these questions. I originally did this one for a podcast for the real estate guys. It was really well received. So I actually did a couple seminars or webinars, I guess, on it. And I said, hey, why don't we do a live on this as well? So I'm not going to go through all of them. I think the original blog I did, and I'm going to send it out with the recording probably tomorrow, had 10, but I'm probably going to go through 6 or 7, or maybe I'll get to most of them. But without further ado, let's get going with the number one question, or the number one thing that a passive investor really should be concerned about is the track record and experience of the deal sponsor, obviously. In fact, I would argue that even though there's 10 questions I wrote, that first one should take up, 80, 90% of the due diligence, right? Because no matter how good the deal is, if you have a below standard or average syndicator, you can grab the best deal in the world, and they'll figure a way how to make it crappy, just to use one of my legal terms. On the other hand, if you have an average deal, or maybe not a great deal, but you bring in a really solid sponsor, they can really do, not say miracles, but can really work some magic with a substandard. A lot of people coming in late today. Sorry, with a substandard deal. There's some nuances here, though, because it's not just sort of your overall experience. Obviously, the track record. Do you have a team? All that kind of stuff. But I would even get more nuanced and argue that a really good question within that first one is, do you have experience in that particular asset class, right? Because there's one thing that, maybe your sponsor is a great, they're in the multifamily, like most of us are. So we're in the multifamily, but this particular deal may be a mobile home park, or a self-storage, or a retail, or whatever. And so it doesn't mean that the syndicator or the main person themselves need to be an expert in the asset class, but there should be somebody on the team who is an expert in that asset class. So I know plenty of clients who started off in multifamily, became an expert, have a great track record, great teams, and now they've sort of expanded into, say, mobile home parks, but they've got somebody on their team who is rock solid in the mobile home park space. So you want to make sure that you're asking that specific question, and you want to be able to make sure that you're able to answer as a syndicator, that you're able to answer that specific question. You want to find out about the specific submarkets, like how well do you know that particular market? You may be an expert in multifamily, but this might be the first time you're venturing out to Orlando, and all your prior deals have been in Arizona, and you don't really have a team over there. You don't know much going on there. So really digging deep into how well, and as you guys know, it's all localized. So, how well do you know that particular marketplace, or even how well do you know that street, this street versus this side of the street versus that side of the street? Have you gone full cycle? That's always a good question to ask. Of course, as our good friend Dan pointed out earlier in one of the social media posts, a lot of syndicators are doing really, really well, but they haven't gone full cycle. They've been doing it for 4 or 5 years. They haven't gone full cycle, so it's a little bit challenging. But hey, that's something I would want to know is, have they gone full cycle, and have they been through a down cycle, right? I mean, we've had a pretty darn good run over the past, 12 years, 13 years, however you want to calculate it. And I don't want to say it's as easy as throwing a dart at the board and you're going to do a good deal, but clearly the market has helped out. And I would argue it's bailed out a lot of syndicators, especially newer syndicators that, in a normal market, may have got into trouble, but sort of the market has bailed everyone out. And so a good question to ask is, hey, did you go through the last downturn, which hasn't been since 2007, 2008? And so again, those are kind of all great questions. Again, I would argue most of my clients started doing syndications, and say most, the majority of them, post 2008. So that's not something that's pretty normal. It's been, again, you could be a 10-year veteran and never gone down through a downturn. But if you can get a good answer to that question, and yes, I've been investing since 02, 03, 04, and I've gone through those downturns, it definitely strengthens your case. So anyway, I think that's sort of my number one due diligence, is obviously the experience of the syndicator. The second one is, what is the experience level of the asset manager or the asset management team? Now this gets a little bit, people get tripped up on this one, because what's very common these days, and you guys will probably know this, is that there's a bunch of sponsors now on a lot of these deals. It's one of my pet peeves, actually, but I won't digress into that one. But it's not uncommon to have 4, 5, 6, 7 co-sponsors on a deal. And so the person that you're communicating with, they may not be around right post-close. You might be talking to somebody that you like, you trust, and you make the investment based on that relationship. And then it turns out that once the deal closes, they're not really that involved in the day-to-day. So who is actually going to be involved in the day-to-day? Who's going to be running the day-to-day show? Who's going to be executing the business plan? Because as we all know, it's one thing to put a pitch deck together with pretty pictures and pretty numbers, but at the end of the day, somebody has to actually execute on that plan. And who is that person going to be, or who is the team that's going to do that? Because it is, unfortunately, somewhat common that there's usually 1 or 2 people that are really leading the charge, and you want to check out what their particular experience is, and not necessarily the experience of the person you have the relationship with, because they may not be around. So that's something else you want to keep in mind. And also you want to find out along those lines is how long has this asset management team been working together? Again, there are clients who have sort of established businesses, and they have their partners that they've done multiple deals together, and they're a team, they're under the same company. But as we all know, we have co-sponsors, and it's not uncommon for sponsors to do one deal with one group and another deal with another group. And so understanding the synergy between those people, I think, is pretty important. So what is the experience of the management team? Is sort of my number 2. What is the investment philosophy would be my question. What is a deal sponsor's investment philosophy? Because as we talked about, I think in maybe, 3 or 4 episodes ago, we talked about the 4 pillars of investing, and then I had Robert Helms of the Real Estate Guys come on. So if you haven't checked out those 2 episodes, I would recommend it. But he always talks about the number one thing to start with is your personal investment philosophy. What are you trying to accomplish through the real estate? Are you a cash flow investor? Are you an equity? Are you debt? Are you equity? Do you want to invest in killer markets? Do you want conservative? Do you want it local? Do you want it far? All those things going into figuring out what your own, as a passive investor, what your personal investment philosophy is. And you want to make sure that aligns with the sponsors, right? So it's very important to understand what the sponsors' goals are. This is why I encourage everyone on their websites to have a section in there about your, what your company's about. What are your values? What are you trying to accomplish? Because if I'm an investor who's looking for cash flow, from day one, and the sponsor has a development deal that's not going to cash flow for the next 2 or 3 years or whatever, then obviously that's not a match. And so it's really important for the passive investor to find, let's go on mute here. It's very important for the passive investor to be aligned in that philosophy with the sponsor. So that's going to be one of my big questions is what is your philosophy as a sponsor? What are you trying to accomplish? Are you trying to get in and out really quick? Are you going to be there for 10 years? Try and make sure that those are all aligned. The next one would be, what happens if you die? What happens if the lead sponsor or the person you're talking to who's executing the business plan, what if they pass away or whatever the circumstances? Is there a succession plan? What is the game plan? Are you going to bring somebody else in? Where is that information located? If there's nothing articulated in the documents, then it's possible that if somebody dies, that their spouse and their kids or whatever may take over their interest in the company. And if they have a controlling interest, now you've got some spouses not involved in the real estate or kids. And so you want to make sure you understand what the succession plan is. That's typically going to be found. The reality is, in the smaller deals, that's typically going to be found in the language in the management company's operating agreement, which you may, as a passive investor, you're not necessarily going to see that. So you may have to make a special request, or at least if you're not going to see the operating agreement, at least ask them point blank, what is the succession plan? Because typically happens if somebody dies, then nothing really happens because the manager is the management company, right? So you're really looking to see who is really running the day-to-day of the management company, because if that manager dies, then you're going to look at the ownership there. You're going to see, well, who's going to have the votes, and is there a plan already in place, or is it just the next person that's in line is going to take over? And that becomes really important, I think, when you are talking about scenarios where the team isn't very familiar with the particular asset class, like we talked in number one. Maybe this is a mobile home park deal and you're really, really strong on multifamily, and it just happens that the sponsor who's the expert in mobile home parks passes away. Well, now crap, nobody else is an expert in that field. What are you going to do? Are you going to go hire somebody else? How is that going to get compensated? So just understanding, what happens if the sponsor dies? What is the succession plan would be a good question to ask. What are the projected returns of the deal is obviously probably an obvious one. And there's a lot of other obvious ones that I didn't include in the list just because you can find them in the private placement memorandum and the offer. Those are kind of things you can find. You don't actually have to ask them. But on this one, I included it because you want to know obviously what the projected returns are. But again, anybody can pull projected returns out of where, and they may not have teeth behind it. So what you're really looking for is what is the underlying assumptions behind those projected returns? Because as a passive investor, what you're trying to do is look at those, look at the pro forma, look at all the numbers and projections, and then you can challenge those assumptions. Maybe the sponsor, everything's been going so great, they're going to assume in their projections that rents are going to be increasing at 9% annualized for the next 5 years. And that therefore you get a certain projection, and you may come in and say, look, I don't think that projection is accurate. I think, at best we're going to have 2% or 0% or 5% or whatever. And you can then recalculate that. And it still may be a good deal, maybe at 5% or 6%, but you want to understand what the underlying assumptions are. What kind of debt are they going to be? Are they projecting to get if they're going to refinance at some point, so that you can really challenge those assumptions? And that's most of that stuff. We try really hard on our docs with our clients to make sure we're disclosing those assumptions that should be in the sort of the risk factor section of the PPM. But it wouldn't shock me if all of those underlying assumptions aren't there. So you just want to make sure as a passive investor that you're just being direct and asking them, well, what are you basing these numbers on? Oh, I see that the rent growth, you can look at the pro forma, the rent growth is this. What is that based on? Is that something that your property manager is saying? Is that based on historic? Just understanding the assumptions so that you can challenge them and you can determine whether you agree with them or not. The next one I have is asking the sponsor, what's the worst case scenario? Like where is the Achilles heels of this deal? Like every deal has an Achilles heel somewhere. And not just, hey, we may have another great recession and, everything might go to hell in a handbasket, but on this particular deal, what is as a passive investor, you're asking the sponsor, Mr. or Mrs. Sponsor, what is the weakest link of this deal? And ideally, I would say actually try and come up with the weakest link yourself first. Ask the question, no matter how good the deal looks, where is the Achilles heel of this deal? And then when you ask them, hopefully they'll give you the same answer and say, yeah, if this doesn't happen, then it's going to be really hard to hit our projections. And again, you're not saying yay or nay, but you're just trying to understand. Maybe it's part of the sort of underlying assumptions and understanding what the worst case scenario is and what the Achilles heel is, and then getting comfortable with that risk is really what you're after in asking that particular question. What's the exit strategy? That's another one, right? What is the exit strategy? Again, that should be in the documents, in the business plan, but you'll be surprised that I've seen business plans that don't have that. So, put another way, Mr. or Mrs. Sponsor, when am I going to get my money back, right? Is that going to be a sale in 5 years? Is it a refinance? Are there multiple exit strategies? Hopefully there's more than one, because most of the deals we have out there are, these days, to be honest with you, they're mostly, if you're in the multifamily, they're value add and they're based on bridge loans, and there's an assumption there, again, assumption that you're going to be able to refinance, in 2 years or once you get the rents up or whatever. And so, okay, great, that's plan A. What happens if in 2 years, interest rates have gone through the roof, or I just can't, there's another great recession and I can't get refinance? What's plan B? What's plan C? Ideally, you want to see at least 2 or 3 exit plans, but you should be able to articulate fairly well how are the investors going to get their money back, and that's really the purpose of that particular question. This came up this morning. This is kind of one of these self-serving questions that I wrote, but I do believe it's important, and that is, are you using a reputable securities attorney, a syndication lawyer? I don't say there's plenty of us out there. There's a lot of us out there. I know everybody's got their attorneys and we're all friendly and it's all good. But I was on a podcast this morning, and I've seen back in the day when I was reviewing other people's documents, I've seen scenarios where people cut corners, and they forget about reputable. They don't even have attorneys because they want to cut corners. They don't want to do a PPM. They want to save a few bucks, or maybe they're using an attorney who's really good at, a trustee, or he's a divorce attorney or a litigator, but he or she is not really doesn't spend day in and day out doing securities laws. And I think that's critical, because as an attorney, my job, yes, I represent the client, but my job is to make sure that the client is disclosing all of the important material information to the investor. And obviously I'm licensed, and that's my obligation. And that's how I help my clients, to make sure that my clients are abiding by all the rules and giving all the disclosures. So as a passive investor, knowing that there's an attorney that's preparing the documentation and making sure that all the important information is in there, gives me peace of mind that, now that I'm reading all these disclosures, this is it. These are all the disclosures. These are all the, what we call material facts. And now I can make an intelligent decision on my own, whether to invest in this deal or not. Maybe, whether I invest in it or not, I've got all the information. And having an attorney that specializes in securities laws really does, I think, give peace of mind to know that somebody's out there giving the proper disclosures. So, and then the last one I'm going to talk about just briefly, it's almost a little bit of, I don't say it's a joke or not, but, do you offer guaranteed returns, right? Because a lot of times people throw out the word guarantee. And I always say, if anybody offers you a guaranteed return, you should turn around 360 or 180 and just run the other way, right? There's no such thing as a guaranteed return. I think it was Clint Eastwood that said, if you want a guarantee, buy a toaster. But there's no guarantee, even if you're personally coming out of pocket, if the deal goes south, there's always contingency. So if anybody tells you that this is a guaranteed deal, whatever that looks like, I would definitely run. So anyway, that was my little 20-minute ramble. I forgot to ask for people, if you've got a question on this particular topic or any of the questions we have, feel free to drop it in the chat. I always like to, if you're new to the program, welcome. I always like to answer specific questions on the topic first that I've just been babbling about, and then I'll open it up to sort of ask me anything on any of the topic. But hopefully that was valuable. I don't know if you have any additional questions that you think should have been on that list that I didn't have on the list, or just some follow-up on any particular deal, but I'm happy to take those questions. I see a couple already. Dwayne, great question, Dwayne. I love this. Is a great question. I'm actually thinking of doing a video on this topic. I think of a lot of videos. I don't always make them, but Dwayne was asking, is a guaranteed return the same as a preferred return? And the answer is absolutely not. In fact, that's my first statement that comes out of my mouth when people do talk about preferred returns, and it's going to be the same. The first thing that's going to come out of my mouth in my video on preferred returns, that a preferred return is not a guaranteed return. It simply means that the investor is going to get 100% of the distributions until they reach that certain number. So let's say a preferred return is 8%. That means all of the distributable cash is going to go to the investors first until the investors get their 8%. And then we're going to split it however we're going to split it. If there isn't enough money, if there's only 4%, if there's just enough money that all of the money goes to the investor and they only end up with 4%, then you end up with 4%. Or if there's no money at all, you end up with 0, right? A preferred return is not a guaranteed. It just means you're going to get all the money first. And until you hit that watermark or whatever, then I'm not going to get paid. Now, there's typically rollover provisions in there. So if you don't meet your preferred return in year one, let's say you're short, then typically you make it up either the following year, or sometimes it's made up at the exit. But that's a great distinction, that a preferred return is not the same as a guaranteed. The closest thing that I get to describing as a guarantee is what I call a fixed return. And a fixed return is just a defined term, so don't get caught up in the terminology. It might not be the perfect term, but to me, a fixed return does mean, hey, I'm going to give you, let's say, an 8% fixed. If I'm short, I'm dipping into my own pockets and giving you the difference. But that to me is it's almost like a note or a debt. Like you owe the bank a mortgage, and if you can't make the monthly payments, if the property doesn't spit off the monthly payments, you're coming out of pocket, or you're coming out of your investor's pocket with a cash call. Similarly, I have done deals before where especially if they're sort of acting more as debt, maybe Class A members, and they're just getting a fixed 10%. If for whatever reason the deal produces less than 10% for the investors, then the promise from the sponsor is that they will dig into their own pockets and give the difference. I'm not saying I recommend that or not. I'm not commenting on that piece, but that's the difference between it's still not a guarantee, because there's no guarantee that, the sponsor may not change their mind, not want to make the difference, or maybe get so much in the hole that they just can't afford to do the difference. And so they end up defaulting. But great question, David, in terms of, Dwayne, in terms of the difference between a guaranteed return and a preferred return. Tim asks, DST. Yeah, I think I'm going to do DST next week. I thought about doing it this week. This is one of the reasons I don't really commit one way or the other on emails or something, but I'm pretty committed to doing DSTs. I was close to doing it this week, and then I just wanted to kind of clean up some stuff. And so if you want to know about the Delaware Statutory Trust as sort of an alternative or another way of doing some 1031s, we're going to definitely talk about that next week, which I think I'm going to be in. No, I'll be here. I'm confused. I'm heading out to the Real Estate Guys event in a couple of weeks. That's not next week. So anybody else going to the Real Estate Guys? If you are, just let me know in the chat. I'd love to connect. And if you are out there, please, come say hi and just remind me that you're a member of the community. And I'd love to, chit chat, grab a drink or whatever. Chris Collins in the house. Chris, you just want to come on and ask it, dude? You want to unmute yourself?
Yeah. So, a lot of us, as you're saying, I haven't been through down cycles with investors involved. I own property through the last down cycle, but it's just personal. But as far as investment real estate, sure, I've gone full cycle and sold deals and every returns are great. But how do you answer that question with strength without being like, nope, I haven't been through a down cycle. Good luck to us all. I don't.
Well, I mean, look, if you haven't, you haven't, right? There's no way to sugarcoat it. I do think that what you mentioned earlier is important, in that the track record isn't necessarily, and maybe I should have been clear on that. I don't think the track record is exclusively your track record as a syndicator. I mean, if you've been doing real estate for 20 years and you've been buying multifamily 20, 30 units, back in the day on your own, and you've gone full cycle, or you've gone through the downturn or what have you, that to me is what I would focus on, because obviously you don't have the experience on the sponsor side. Now, it doesn't help you in terms of, well, I guess it does, when it comes to, do you have the team and do you have processes and stuff, that you can definitely talk about that. But I think that's how I would answer it. If you have that experience, then I would rely on that. The challenge becomes, what if you just started doing real estate and you started in 2013 and you've been killing it for the last, 9 years? It's going to be a hole, and you're not going to fill that hole until you do go full cycle. But I think if you have that experience previously, I would immediately go to that. It's not necessarily experience as a syndicator. I mean, man, if I'm investing with, it's difficult to raise money your first time, but if you've been investing in mobile home parks and buying huge parks for the last 20 years, and you just kind of either decided to go even a step bigger, or you just kind of ran out of your own money, or you ran out of your own credit, and you decided to put the syndication together, you've never even done a syndication, I'd be pretty comfortable in investing with you based on that track record on your individual or maybe a partnership standpoint. So I think that's how I would rely on that, if you've got that experience to rely on.
All right, thanks.
Thanks, Chris. Good seeing you, my friend. Let's get you back on mute here so we don't. All right. Oh, here, Moses is, yeah, this is another, that's a great question, Moses. I hadn't actually even thought of that one. And I think that's a good one to ask, which is, are you doing this full-time as a deal sponsor? It'd be interesting in other people's comments of whether that should matter or not. But yes, there's some of us, not some of us, some of my clients who, this is all they do day in and day out, and they're full-time and they've been doing it so long and they've got the experience. And yet there are others that still have a W-2 and are doing it on the side. I can see pros and cons on both of them, but I think it's a good question to ask and figure out whether they're doing a W. I just spoke with a client the other day who loves his W-2. He's an executive at a what do they call, not the Inc. 500, but anyway, a top company, loves it. Has no desire to quit the job, and he does this, yes, on the side. So that's where it gets a little bit tricky. Is like, how much time are you really devoting it to you? But I've got a lot of great clients that continue to do their job. Doctors do. That's a good example too. I've got a lot of doctor clients who are killing it, doing a really nice job for their investors, but they love what they do and they continue to do the medicine stuff. So, but I think that's a great question. Are you doing this full time as a deal sponsor? Great question, Moses. Christian's got his content in. I encourage you guys to all connect. By the way, I know sometimes we put websites in there and LinkedIn, so definitely check out there. Chris, you had a suggestion. Are you using a reputable attorney? Okay. Chris is crushing it here with all these questions. I'll answer them, buddy. Are you using a reputable attorney? Question: what are the risks of not using a reputable attorney? What can be wrong in docs for the investors? So like I mentioned, I think when people start cutting corners and forget about not even, let me just backtrack. I've seen deals where there is no PPM, for example, no private placement memorandum when there's supposed to be one, right? And the only way that can happen is if you're dealing with somebody who does not have an attorney, or has an attorney who has no experience in securities laws. And that doesn't mean they're a bad attorney. It just means that's just not their field. I've had calls from attorneys multiple times who've called me for help with the securities where they literally said something to the effect of, hey, I was about to recommend my client to go raise and just do an operating agreement or just do this or just do that. And one of their colleagues say, hey, dude, that might be a securities offering, and they're like, oh crap, I didn't even think of that, right? So just because they're a really reputable, just like me, like, I don't know anything about intellectual property. So if an IP thing came up, I'm probably the dumbest person in the room when it comes to intellectual property. That's just not my style, my forte. So I think that's the main one is people cutting corners. So if they're cutting corners on legal fees or PPMs, where else are they cutting corners? But I think the main one is just if you have, I'll give you a great example. There was somebody that sent me over a PPM many years ago to review, and they had some concerns. And I knew the attorney who drafted the PPM. And I was like, that's it. All I need to know is who drafted the PPM, because this is an experienced attorney. I would almost call him, I would say one of my mentors, but an older gentleman. I've interacted with him in the past when I was just starting out. He's a pro. So if this person is the one drafting the documents and helping you with the compliance, I'm going to feel pretty good that the documents disclose everything that they need to be. And that's ultimately what you want as a passive investor. You want to make sure that all the risks are disclosed, so you don't suddenly find out later, oh crap, I lost all my money and I didn't know that the sponsor, had committed, embezzlement of client funds, 5 years ago, or just got out of jail for, tax fraud or whatever. So anyway, I think that's the big one. And then your other question about guaranteed returns. This is not directly related, but question: what is reasonable for investors while their funds are tied up before closing? Good question. Say that closing gets pushed for months. Investor does the wire and closing gets pushed 3 to 6 months while your money is just sitting there. This is a good question. There are certain deals that are structured that way. They're funds, and they're not going to actually start providing any returns until they reach a certain number, or after some. I've got a client who does it. There's no real return until a year in, because they need time to, it's a fund, and so they need to get time to go build the team and acquire the assets. And I've seen small, honestly, sometimes negligible returns in those. I mean, the one I'm particularly thinking of was like a 2% return during that whole period. But I think, the ones that I've really tried, that are, for example, development deals, I've seen like 6%, 5 or 6%. The idea is it's better to put the money with you and earn 5% than put it in the bank. But I think that might be the argument with the bank too, right? If you get 2%, I mean, where are you going to get 2% even these days? A CD or something? I'm not sure. So, but generally speaking, if it just gets postponed because of it's getting postponed, generally speaking, I don't usually you wouldn't see any interest during that holding period, because you didn't anticipate that it was going to get delayed 3 to 6 months. And so it's not in the documents, and you don't want to go back and change all the documents and revise them, because then you'd have to do a material change letter. We'll give people the opportunity to get out of the deal, which if it's already delayed 6 months, they may be enticed to. So if you didn't promise that on the front end, it's like, hey, in the event of a delay, we're going to pay you X during that time, then it's just not going to happen. The challenge, as you probably know, Chris, is that, where does the money come from, right? The only way to pay that holding period, if the property isn't, it's just getting delayed, is either over raising, right? So you need $1 million, you raise 1.1, and you use that 100 grand to pay that return while it's not making any money. But that's all stuff you've got to disclose. So unless you put it on the front end, which I rarely see, and rarely clients want to do it, it's just challenging. But if it's planned, I've seen it somewhere between 2 and 6% of a holding cost. But then you got to figure out, where's the money coming from? And ultimately, I think most people end up just saying, look, don't look at it for the next 3 months or 6 months. Look at the entire period of the investment, and trust me, you're going to be happy at the end of 5 years when this is all said and done. 3% over 6% over a 3-month period is nothing. You're going to make it up on the end. So anyway, I hope that answered your question. Thanks, Chris. Thanks for great questions here. Armando asked, what is a good preferred return range? What's a bad preferred return range? That's all going to depend. I can tell you what the range is having done, we do hundreds of these a year. So I can tell you the range is, it's really a tight range, to be honest with you. It's usually 7 or 8% if there is a preferred return. I think now things that as the deals get tighter and tighter, you start seeing less and less of a preferred return. I would say, a couple of years ago, virtually all 80-90% had a preferred return. Now I'm seeing less and less preferreds because sometimes the deal just doesn't pencil for a preferred return, especially in the first couple of years. But if you do see a preferred return, I usually see a 7 or 8. Whether that's good or bad, I think that's deal specific. I don't think I can answer that in a vacuum. What is a good preferred? What is a bad preferred? It doesn't mean the higher the better. I mean, if anything, sometimes I see a preferred return of 10%. I say, okay, what's wrong? Why are they offering me a 10% pref? So I don't know about good or bad, but I can tell you based on the hundreds and hundreds that we've done here in the last few years, it's always between 7 and 8% is what you typically would see as a preferred return. Julie, can you do? Yeah, I will definitely do. Can you do a DST versus a TIC? Yeah, so I did early on in the series, we did a whole. Well, maybe it wasn't specifically a TIC. I did a 1031 video and went through all the limitations of the 1031. I think that was like the 5th or 6th episode. But yeah, when I do talk about DSTs next week, we'll definitely compare those with the tenants in common. But the main reason is obviously going to be the tax treatment and whether you want to do that 1031 via a TIC structure and the limitations there versus the DST. So yes, Julie, I will definitely discuss that next week. Thank you. Jeremy, with regards to reputable SEC attorney as a sponsor, what should we expect to pay for their services? Is it a flat fee? Most of the attorneys most of the attorneys in our little group, right? So you probably know them. There's probably 4. There aren't that many of us, to be honest with you. There aren't that many attorneys that just do this full time, right? That they don't do anything else, or they're not part of a large firm. And we all know each other. You guys know them all. That you've been to the events and the seminars, and we're all friendly. We're all good. I believe almost all of them will charge some form of a flat fee. And that flat fee, I would say, ranges between 12.5 and 15 or 17, something in that range. So it's a flat fee. I would just pay attention to the details in terms of, is that it? Is there things that are not included in that flat fee? And what is the hourly rate after that? Just make sure that when you're shopping around for the price, that you're just comparing apples to apples, because sometimes the flat fee may be lower, but then the entities may be additional, or some other things may be additional. But I would say the good range is somewhere between 12.5 and 15. Anything that's below that, you're now, then there's definitely outfits out there that are doing it for, I think they used to do it even cheaper, but now even the cheap outfits are doing it for 7, 8, 9, 10 grand. First of all, a lot of those aren't even law firms, right? So they're just practitioners, and they specifically, if you look at the fine print, they'll specifically say, we're not lawyers, so take this document and have your lawyer review it. So you got to go hire a securities lawyer to review it by the hour, which is going to be tough for you to do. But what you're really looking for, here's my one piece of advice. One of my biggest pet peeves on the securities side is sponsors believing that the crux of this thing is to bang out a bunch of docs. And so that's what the sort of the cheap 5, 6, 7, they're not attorneys, and they just take a questionnaire and they bang out a bunch of docs. What you're looking for is an attorney that knows securities laws so that they can make sure that you're raising the money in full compliance with federal and state securities laws. They want to make sure that you're abiding by all whatever the rules are of whatever exemption you're relying on. You want to make sure that you're not paying, that the co-GPs aren't acting as broker dealers. You want to make sure that you're not having to worry about the investment advisory rules or all these other things that us securities lawyers have sort of a bag of tricks or a bag of knowledge in the back of our minds. Maybe 90% of the time we don't use it because we don't need to, but we're always scanning for issues that may arise, that if you're not a law firm, or certainly if you're not an attorney that does this day in and day out, you may just not see it and not realize, like, what? This may be an issue. Maybe this co-sponsor, we're not supposed to be paying them a percentage of the GP based on the fact that they're raising money. And we don't have that in writing before the raise, little things like that. So that's my biggest thing. But if you are getting a quote unquote reputable SEC attorney, and that's not a law firm. Law firms might charge 15, 20, 25 grand, a larger law firm, meaning a national law firm. But us little guys that you've seen at the seminars are somewhere between 12.5, 15, maybe 17 once you add some of the add-ons. Vincent Holster is going to the Real Estate Guys event. Vincent, definitely please stop by and say hi. How does TIC work? Iman, how does a TIC work for seller finance deal? Let me check that on the back end and see if there's any other questions on, then I'll get back to that one. Randy, I would also argue that track record could pertain to their W-2 experience. Yeah, high performers tend to perform at a higher level in all areas. I have clients who were, acquisition managers or asset managers within a syndication company, and they were W-2, or they were just, getting paid as sort of an employee or contractor. And so, yeah, if you've been doing that for a company for 12 years and you've decided, you know what, I'm going to go out, branch out on my own. Maybe you've been working under the mentorship of a really well-known syndicator, and now you want to go out on your own. That's how most people start. I mean, I haven't seen that question yet, but I think one of the questions I usually get is, hey, I don't have experience. How do I get around this question? And the way around that question is to go get coffee for a syndicator, get 2% of the GP and just learn, right? And just try and add value as much as you can to the experienced syndicator so that they'll bring you under your wing. And I don't want to say it's an internship because you're going to get paid something, but you're not there to make 2% or 5%. You're there to learn. And then after you've done 2 or 3 of those deals, then, hey, you can then branch out on your own. And so that's something that would absolutely work in that scenario. Or like I said, if you're a W-2, even a W-2, I would definitely, it's all about the experience, whether they're a sponsor or a W-2. I think that works too. Tristan, thank you for that. Kenneth, 22 questions every investor should ask before investing. Is this another? Oh, that's a long one. You guys can actually, let's go through them real quick. It says 22 questions. Did you put 2? I see 10 of them on here, but let's go through some of these real quick. 22 questions every investor should ask before investing. These are questions you should ask the deal sponsor before investing any funds. This is Kenneth Peltz. Sorry. So be thorough and remember that sponsors are used to being used to ask these questions. So these questions shouldn't offend them if they get pushback. Number 1, can you share your track record? We've done that one. Have you sold any of your prior deals? That's going full cycle. Can I speak to a couple of current investors? I think I do address that somewhere in the article that I'll send out tomorrow. That's the challenge, right? So when you ask a sponsor, can I talk to some of your investors? Who do you think they're going to connect you with, right? The investors that, are about to file a lawsuit against them for incompetence, or, their brother-in-law who's going to obviously say raving reviews. So that's the biggest challenge, is how do I find independent, sort of, unbiased feedback from investors, and not just the investor that I'm getting spoon-fed by the sponsor. And that is a challenge. I don't necessarily have an answer for you. Maybe, with social media and all these seminars, it may just be, hey, does anybody know anybody who's invested with this particular sponsor? And then you can go pick up the phone and connect them directly. I would definitely avoid, you're going to get spoon-fed their best investor. But anyway, so can I speak to a couple current investors? What has gone wrong in a deal? Yep, that's a good question. I think that goes to my, what's the Achilles heel of this one? But yeah, in the past, what's gone wrong? And I presume you're going to say, how did you fix it? Make sure you something substantial here, as things never go exactly as planned. Someone who doesn't have a good answer is either not being forthright or yeah, I think that's right. So we talked about, what's the weakest link in this deal, but, a good question is, what's gone wrong in the past? And I would then do the follow-up was what did you do? What did you do to fix those, whatever that issue that you were dealing with? But that's a good question there, Kenneth. Have you ever lost money in a deal? Great question. Have you ever needed to do a capital call? That's a good question too, although I'm not sure if that, I'm not sure if that's, I guess I would want to know that. I'm not sure if that's indicative one way or the other. I mean, there are plenty of deals that, have challenges that you end up doing a capital call. Number 7, have you worked in this geographic area before? Absolutely. The submarket, we talked about that. Have you done this type of project before? Same thing, asset class. And who's on the sponsor team? I would probably start with that. And what is each person's role? 100%, that's in the article. And what are the rent growth assumptions? Again, assumptions I think are key. So one of the reasons I always talk about why it's harder for people to raise money in a fund, like a blind fund, it's because you don't have assumptions. You don't even have properties. And so it's really not difficult. It's impossible for an investor to take those assumptions like they can in a specific deal and question them and make their own assumptions. In a fund, you give parameters, but that's why it's harder to raise money in a fund. Dwayne, my value add. Oh, okay. Dwayne's giving a value add here. My value add is knowing the Arizona market, and I raise equity for deals. Everyone needs money, right? So I encourage everybody to sort of interact here. If you're not part of the Facebook community, we interact a bunch over there. I'll put a link down there, but it's a Facebook community. It's the real estate syndicator community. It's mauriciorauld.com/FB group. I'll put it in the chat real quick. mauriciorauld.com/FB group. I'd love for you guys to join us there. A lot of questions. Keep them coming. Let's see here. Oh, wow. Okay, let me go back up. Sorry. Oh, it's a lot of. Okay, here we go. Tenny's looking to collaborate. Again, he put their contact info, so I encourage you guys to connect. Kenny, sorry, can't get all 22. That's all right, my friend. Those were great questions. Capital calls. How are you seeing this approach? Just a general question. No planning, not planning one. I mean, the capital call mechanism should be hopefully clearly outlined in the operating agreement, right? And so whenever you need to do a cash call, or if you're a passive investor and you're the subject of a cash call, the first thing you want to do is open up that operating agreement, go to the section on, additional capital contributions or cash calls, however it's articulated. And there's going to be a process. There should be a step-by-step process. At least ours, it's exactly, when do you do one? How does it get paid? What happens if you don't get paid? Sometimes there's a dilution. I mean, you want to encourage, let me just backtrack a little bit. The cash calls are tricky, right? Because it's difficult for a sponsor to say cash calls are mandatory, because as a passive investor, when you're investing in a deal and I put in 50 grand, I want to know that this is it. Like if I put 50 grand in the deal, that I don't have to go put another 25 grand next year or 50 grand the following year. So it's difficult to put a mandatory cash call provision in the operating agreement. So what typically happens is, even though it's not technically mandatory, there are typically severe or punitive, not punitive, but severe consequences to the passive investor if they don't do the capital call. Because obviously if we can't get the capital, we may lose the deal and everybody loses the money. But on the other hand, people don't want to give the cash call. So there's the two main ones that I will address that I've done both of these. One is if somebody can't do a cash call, you can write into the operating agreement that somebody else can do the cash call for you on your behalf, and it's going to act as a loan. And it's usually whatever the maximum interest rate is, 12, 18, 15, it depends on the state you're in. But that way, if I don't do a cash call and investor number two can have the option to put that money in on my behalf, it acts as a loan. So that means anytime there's distribution in the future, because the sponsor controls everything, they'll give that money to the person who did the cash call until that note is satisfied and the interest is satisfied. So that's one way to do it. And then the other way is just dilution, flat out dilution. Like if somebody puts in money and somebody doesn't, then they're going to end up with a higher percentage relative to how we started. So maybe I started with 3.5% and we both started at 3.5%, but if I'm putting additional capital, I'm going to own 4 and you're going to own 3. So those are kind of the two mechanisms for cash calls. But what that ultimately ends up being has to be predetermined, discuss with your securities attorney, and they'll have, usually they have kind of standard language that they start with, but that's something that you want to have that's why you want to have that conversation with your attorney to see is that the way you want to do it, or is there another way that you want to have those cash calls. So hopefully that answered your question, Julie. Randy Smith, connect with Randy. He's in the chat. Tenny, if there's no preferred returns, actually, know that we're getting away from the questions, and I know Aman had a question too. So, okay, maybe I'll go back to Aman and then I'll come down the list here. So Aman asked, if I can find him. There's a lot of questions today. Thanks, guys. Really appreciate you guys playing all out here. Aman, are you on? Do you want to? I lost you, buddy. Do you want to ask your question? Just unmute. Aman, you want to unmute yourself?
Hey, how you doing?
Hey, good. How you doing?
Good. You talking about the one where I asked, what is a good preferred return? What is a bad preferred return?
Oh, yeah, we got that one. Oh, here, I think it was the TICs work for seller finance deals.
Yeah, that was someone else that asked that. That wasn't me.
Yeah, that's what I was like. Aman Shahi.
Oh, okay, Armand. Gotcha.
So how does a TIC? I found it. So how does a TIC work for seller finance deals? I don't know why that would work any different than traditional. I mean, the only difference here is that you're getting the seller to give you the dough, unless you've negotiated something where they're not transferring title, but that's not the way it usually works. Usually the seller finance, they're transferring title to your syndication LLC or you personally, and they just have a note and it's secured, usually in first or second position. But having a TIC amount, I'm not sure why that would make a difference. Just trying to think off the top of my head real quick, but yeah, I mean, it's just a difference between being a lender, whether it's a bank, whether it's a hard money lender, whether it's a seller. Finance is finance. So I think that however the TIC is going to work with traditional finance should work the same with a seller finance, unless the seller finance, the seller wants to be involved and retain some title. But that, again, that's the same thing with an LLC that we do sometimes negotiate where they'll sell, but they'll retain a percent. Look, for example, hey, I'll do seller finance. I'll sell it to your LLC, but I want to retain 5% of the deal, and you can negotiate all that stuff. But I don't think it's going to make a difference whether it's a TIC or an LLC or something else. So unless I misunderstood your question, I apologize, but I don't think there's a difference there. All right, so then I got down to, and feel free to do a follow up at the bottom there. Come on. If there's no Tenny, if there's no preferred return in the first year, does that deter investors? Well, there's two parts of that question. One is if there's no preferred return, period. And then the other one is there no preferred return in the first year? I mean, some deals can't have a preferred return, especially in the first year. I mean, if it's a development deal, it's going to take 18 to 24 months for you to actually get a return, then I don't think that's going to deter. It just depends on the deal. Again, I'm going to punt to the facts and circumstances. I think every specific deal will be different, but I don't know if it'll deter investors. It wouldn't deter, just on the face of it, it wouldn't deter me. Again, it just depends on the deal, right? If it's a crypto fund and we're just swinging for the fences and it's all equity gains and, you know, I'm either going to make it or I'm going to go broke, then it doesn't matter. But if it's a traditional one, again, I think it just depends on the deal. They're going to have turnaround stories. You know, if there's a heavy value add, they may not have cash flow in the first year, even if it's not a development deal. There might be so much value add that they've got to remove people. They've got to basically evict tenants, and it might be 50% occupied for the first couple of years until they get those back up. So my personal, and how anybody else feels, it would definitely not defer me. And I'm a passive investor like a lot of folks. You know, I've got my law practice, and so I love using you guys to leverage your guys' time and experience. So it wouldn't deter me if that means anything. Alan, we were looking at being a co-GP with a lead GP. I don't like those terms just to begin with, but you're looking to be a co-GP with a lead GP that has a long reputation for not allowing the co-GPs to do help out in any way. We are looking at being a co-GP with a lead sponsor that has a long reputation for not allowing the co-GPs to do help out in any way, shape, or form. What are you doing in there?
Yeah, I accidentally hit the enter button too fast.
Oh, they got it. Yeah, this is an interesting one.
Yeah, so, you know, we're GPs in about 5 deals, and every now and then somebody asks us, hey, do you want to be a GP along with us? I always look at the deals. Most of the time I don't do it. Well, this one person, we were kicking it around, but then I asked some of his other GPs, what's it like working with him? And they hated it because they're more or less not allowed to help. They can't go on property tours. They can't, I mean, even like pick a paint color, they're not allowed to help. They don't help with the webinars or anything. I mean, that's like more or less really illegal, right? Or just
well, there's two things.
Capital raiser, right?
Yeah, so a couple things there. Yes, if you're bringing in capital and that's really why they want you there, then that's going to be non-compliant, because one of the rules in order to be allowed to do that is you have to be doing what we call substantial duties. And if you can't, I'm not saying picking the color, but if you're not even allowed to go on property, like, what are you doing? That would be my question. Like, okay, what are you going to be doing? Because if I can't do all this other stuff, so that'd be like a red flag, number one. And then number two, if your goal, and it's not, well, on your particular question, it's not the goal, but if your goal for the prior question is to gain experience, like, hey, I'm inexperienced and this is a really experienced, so I'm going to come in as a co-GP. The whole idea is for them to teach you and show you the rope. And so I mean, I think you kind of answered just in the tone of your question, your own question, which is, what's the point if they're getting nightmare reviews and they're not allowing you to do anything? And you run the risk that if you're bringing in capital, and it's found that you're not doing substantial duties, well, then now you're acting as an unlicensed broker dealer. So they have a problem because they're taking the money and they're paying you in a cut of the GP, and they're not disclosing that they're paying unlicensed broker dealers. Why would you? And then in your case, you're running the risk that that compensation could be what's the word I'm looking for? Expunged or whatever it is, the term. You may have to give that back if it turns out that you were, nailed for being an unlicensed broker dealer. Part of your penalty will be to return that plus interest plus fees or whatever. Disgorgement, I think is what it's. Yeah. So yeah, that doesn't sound. But just based on the tone of your question, it sounds like you kind of knew that. I'd be yes. If you're bringing in a legitimate amount of money into the deal, like not just, hey, I'm going to be a co-sponsor. Like, what are you doing? That would be my question to you. What are you doing? You're going to get some percentage of the GP, presumably, because you're going to be a GP. What are you doing? And then
I don't need the practice.
What you're doing is just bringing in a bunch of money from your investors, then that's going to be problematic.
Yeah, and they also want us to sign the big bank loans every time too, which is
that's a different story. So that's a different story. If that's what they want you in, then that's different. So there's nothing wrong. Let's be very clear on that. There's nothing wrong for a sponsor to compensate a key principal for signing on the dotted line, because you need the liquidity requirements, you need the net worth. And if you're getting compensated for that, and they say, look, you're going to have no involvement in the deal, but that's the only thing you're doing, then I don't think that there's going to be a problem with that if you want to just get compensated for lending your balance sheet. But if you're also bringing in capital, right? Yeah. That's when all these issues pop up, is if you're bringing capital. We were having this discussion this morning in this podcast I was doing. If you're the KP, for example, then there's no reason, you're not bringing any money. There's no reason for you to be part of the management team if you don't want to. The other one was, maybe you found the deal. Maybe you found a killer, you have a relationship, it's an off-market deal. You bring the deal to the sponsor team and say, great, thank you. We're going to give you 5% of the GP for bringing us this great deal. Nothing wrong with that either, because you haven't brought any capital. It all starts falling apart when you are also bringing in capital, and then you have to start justifying that you're not getting compensated for bringing the capital. You're getting compensated for signing on the dotted line, which is that's an easy one, because what is that worth? It could be worth 5%, 20%, 30%. You've got some wiggle room there, but let's not kid ourselves around. That's what you're getting paid for. Then is signing on the dotted line. Then, well, I was going to say, then I guess you wouldn't want to know what's going on in the management.
I know you still want to know.
You don't want to know because.
Anyways.
So anyway, great question, Alan. Thank you.
Thanks. I'll see you at the old Capital thing too.
Oh, great, awesome. Looking forward to it.
Yeah.
Mustafa, cumulative versus non-cumulative prefs? Question mark. I can comment on them, whether one is better than the other, I don't know. But a cumulative pref simply means that, and it's probably the most common, right? A cumulative pref simply means that if for whatever reason you're short on your preferred on any given year, that will then roll over essentially and will accumulate generally to the following year. So let's say you're giving an 8% preferred, you were only able to give your investors 6% this year. Then next year, you've got to give them the 2% that you were short plus the 8% for the following year. And I have seen some clients that will actually want to just do that at the end. So you kind of keep track. Hey, we were short 2% in the first year. We were short 1% in the second year. But once we refinance or sell at the end, that's when we're going to, catch up or whatever. But whether one's better or not, I don't know. Well, for an investor, for the passive investor, obviously you want it to be cumulative. So I shouldn't say I don't know. As a passive investor, you want it to be cumulative, because otherwise, if you're short and you get kind of screwed. But the vast majority of, I want to say 90% plus, are going to be cumulative, because otherwise it's not a good look for the passive investors. If you're short, then you're just SOL. It doesn't usually work for investors. Douglas, 504 giveth. I'm not sure what that means. Is that rule 504?
Rule 504 is pretty awesome. It lets you have unlimited numbers of non-accredited and accredited up to 10 million. Was getting kind of interested. I'm like, hey, that's kind of cool. And then I read, for example, California state law, and it's basically, hey, yeah, that's funny, that's cute. And because you have to comply with state law with 504, it sounds fun in theory, but in reality, nope.
That's why nobody uses it, because one of the, whenever, if you've heard me speak, usually I say the reason that 506B, 506C, and now Reg A+, which didn't used to be this way, or the old one didn't used to be this way, is there's two reasons those are very popular. There's a reason why 506B, 506C are 95+% of the exemptions. Number one, they are safe harbors, meaning if I comply, I'm assured of compliance. But number two is that they preempt the states, meaning if I comply with the federal law, I don't have to worry about California securities laws or Texas securities laws or Florida securities laws. With a 504, that's the only remaining Reg D out there, Rule 504. Yeah, it's got all these really attractive, potentially attractive stuff, but it doesn't preempt state law. So if you've got investors in 4 different states, you're gonna have to go hire an attorney in 4 different states. You're gonna have to comply with the security laws in those 4 different states, and you're gonna have to structure your syndication to fit within those, so now you're dealing with 5 statutes, the 4 states plus the feds. So it's a nightmare. And so the only reason you would even consider 504 is if you literally had everybody was in 1 state or maybe 2, but then there's other easier exemptions if that's the case, right? There's an intrastate exemption. There's a bunch of other ways. That's why almost nobody uses 504. But good question. Good question. But state that. Oh, I see. But state law taketh away. Yes, yes. Julie, on the DST versus TIC, could you address lending issues as well? Yes, I will. I'm not. I'll be honest with you, right off the top. That's something I'm going to dig into and be ready for you with that, because I'm not. I'll look into that, but I will definitely address that. All right, I got a couple more. Man, you guys have lots of questions. I'm not going to get all of you. Let me just see. Drop the question though, or maybe I'll cut and paste these into the community. That's what I'll do. I'll just put these in the community and answer them there. Maybe I'll do even an independent video for you guys. Tenny, if we purchase a property inside an opportunity zone, can the fund receive opportunity zone tax benefits without having an opportunity zone fund, a fund dedicated only to the opportunity zone properties? I did an article on opportunity zones. It gets complicated, but you have to qualify the fund. I'm not going to get it. This could be if it was actually popular, I'd probably do a whole live on it, but it's not. And so not too many people are doing it, but you have to qualify the fund in order for it to be an opportunity zone. So you've got to file a form, and then you got to follow all the rules, right? 90%, if it's real estate, probably 90% of the real estate has to be in the opportunity zone fund in order to get these tax benefits. Now there's actually, I guess, only 1 tax benefit, well, 2 tax benefits left. One, it used to be 5 years and 7 years. The 5 years is up. And so anyway, I did a pretty in-depth article, Tenny, and I'll drop it in the Facebook community. Emma, what are the pros and cons of the new 504 and CF options? 504 we just talked about. I don't know about the cons are it doesn't preempt state law, which is why nobody uses it. You want preemption. The CF options, that's a legitimate option. I think you mean regulated crowdfunding. I think that's what you mean. That's legit. The only issue is you're just limited. It's I don't know what the number is now because it's adjusted for inflation, but it was like $1 million. But I think they temporarily increased it actually to $3 million. But there's a bunch of limitations on regular. I also did an article on that. So if you want to remind me, Emma, I can drop the regulated crowdfunding. But they did update the number. It used to be that you could only do $1 million, and that was like $1 million plus adjusted for inflation in a 12-month period. That number went up. I think it's only temporary though, because I think it was a COVID thing, unless they made those permanent. But anyway, I'll drop that article in the Facebook community. All right, I'll do one more. See if there's somebody who hasn't asked a question yet, and then I will answer the rest. Actually, I'm going to end with this. It's 5:30. Julie has just a funny comment. If Alan is the KP, I think. Oh, Alan. Oh, I'm sorry. You're talking about Alan from Alan Neely. I thought you meant. I'm sorry. If Alan is the KP, I think he gets naming rights on the building, and he gets to help choose paint colors. I think that's right. No, that's a good point, though. I mean, obviously, if you're, and I've never acted as a KP, but if I was going to be a KP, and even if you do the Alex Kogan live that we did about KPing, I don't know, 5 or 6 episodes ago, he was very specific. Like, if I'm going to KP, then I'm going to want some, at least some oversight, some veto powers. Maybe he's not going to get involved in the day-to-day if that's the arrangement, but to not be able to even show up to the property, I think that's going to be a big no-no. So anyway, guys, 5:30. Appreciate you guys' time. I will definitely cut and paste these questions in the Facebook group. Again, mauriciorauld.com/FB group, and I will answer those either in written format or I'll do a quick video on those because we have a lot of AMA questions this week. So glad you guys show up. Really appreciate you guys, and we'll see you next week on DSTs. Thanks, everyone.